Good morning and welcome to the SMARTSPACE Software PLC Trading Update Investor Presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I would like to submit the following poll. I would now like to hand you over to CEO Frank Beechnor and CFO Christian Shaw. Good morning to you both.
Good morning.
Morning.
Morning. I'm Frank. This is Chris. So good to be online with everyone again this morning, reporting on the year ended 31st of January. Just as I suppose a quick overview is things are going in the right direction. We're cash positive for the last quarter. We've seen strong growth, which we'll go through in a little while from all the businesses. Swiped On has been EBITDA positive for the year. Space Connect has actually been cash generative for the last half of the year, both of which are very positive, and we've come in slightly ahead of expectations on cash for the year end.
Just to summarise really on the financial highlights, so we had revenue for the year of 7 million, up on where we were last year. We had 5.1 million last year, so good growth in the year. That's come through pretty much all of the businesses. So we saw good, strong growth within Swiped On. As Frank mentioned there, Swiped On is EBITDA profitable this year. It's the first year that's had an EBITDA profit, and also continues to contribute cash to the overall group as well. Space Connect made good progress in that business as well, and that business was also contributing cash. So it had a positive cash flow throughout the year from July onwards, and we expect that to continue into the next year as well. Anders & Kern, the other business, it also returned to more of a normal level. Didn't quite have a strong second half of the year as it did the first half of the year, but it did see good growth in its revenues compared to where we were the previous year. You can see in this graph here on the right hand side, this is our cash balances. These are the cash balances that we've reported over the past year, and you can see that there's definitely been a stabilisation in terms of where we are in terms of burning cash, and we've got to the point where we have been cash flow break even for the last 4 months of the financial year. And as we look forward into the coming financial year, we expect that overall the business will be break even over the coming year. It won't be. It will reduce in cash balance in the first 4, possibly 5 months of the year. We always have a higher cash burn in the first few months of the year because we have some significant outgoings at the beginning of the year, insurance and audit and things like that go out at the beginning of the year. But overall for the year, we expect us to be cash flow break even in the coming year. You can see here a graph here just showing you the growth in the recurring revenues on the left hand side. That's the kind of the dark grey blocks, and you can see that we've consistent growth in those recurring revenues for the past I think it was probably 8 half-year periods there. The red blocks at the top are the non-recurring revenues, which comes mostly from the A&K business, which is where we have less consistency in terms of that revenue in comparison to the recurring revenues, which are very easy to predict and forecast going forwards. The right-hand side graph shows you the ARR, the annual recurring revenue for the business, and again that's consistently grown throughout the past few periods as well.
In terms of Swiped On has performed particularly well last year, despite the sort of general economic climate. I mean, Hadley and the team in New Zealand have been doing a sterling job. Our ARR is up 29% on the year. We've also ARPU has increased as well in the year, and we're obviously focusing a lot of our energies into going after the higher value customers, ideally ones on our enterprise plan, but definitely ones with the multi-location customers. So we're now up at 8,298 customers compared to 7,000 in this time last year. Churn is continuing to decline. At one point we reached, I think it's 15%, it's now down to 11%. The main reason for that is that we seem to have come out of COVID-related churn. We had a lot of customers, generally small ones, who tend to sign up as monthly pays, who would have been forced to have something in place because of local regulations to do with COVID. Once those regulations lifted as we moved through last year, they would have stopped using the product. And in fact, in November, I think we had our first month where we didn't have any COVID-related churns in Swiped On, which again was very encouraging. In terms of desk management, we've grown that base a bit, but our main focus is there's one key customer there, and an Australian consulting business who've got operations in sort of across all continents actually, but we're in 4 regions with them currently. They've just tipped over 4,000 desks. Now they've 10,000 people globally across, I think it's about 200 offices in 20 countries. So we've got a way to go on that, but showing really strong growth. And there's a reason for that sort of, I suppose, treading water on desks, and that we're busy on working on spaces, which we'll talk about in a little while. And we see a big opportunity coming for that, where we can offer people, our customers, a fully integrated product. We are, you know, as we went through last year, we launched in Korea, which is a big learning curve for us. We had New Zealand Trade and Industry worked with Hadley and the team and Swiped On to sort of, I suppose, assess the market across the Far East, and they've done a great bit of research for us. The net effect of that, combined with our own demand from customers, means now that we're getting ready to launch in China, Hong Kong, and Taiwan. When we talk about going into those markets, it's just like Korea. It's fully localized product with full localized marketing, websites and ad spend and everything, and then local language support. So it's not just a simple reskinning of the front screen. So it's very much a cornerstone of our business for this coming year, which is to increase our geographic footprint and move away from our dependency on the 5 core markets, which we've always had: the US, Canada, UK, Australia, New Zealand. We've made great progress over the development team under Matt, the CTO in New Zealand. I think in our last update, we explained that we'd brought the dev teams together, and our aim ultimately is to end up with a single platform. What we're doing is building that platform out of Swiped On. We had a number of options originally. We could have built something new from scratch. We could have built a link between the 2 platforms, Swiped On and Space Connect. We could have built it out of Space Connect, or we could have used Swiped On, where we had a lot of the standard features that we'd want in any platform already built in. We decided to go down that route because we've already got multi-language capability in there. We've got in-region hosting. We've got ease of sign-on, so people pop in their credit card and can get going easily. So we won't have to recreate all of that. After that, then it was taking our learnings from Space Connect and replicating that functionality in the platform. Now, we've been very conservative in our numbers this year, to the point at which we got very little in our budgets for that. And in fact, we were anticipating we'd launch it probably around August time. Our ambition is to bring that forward. The sooner we can get selling that, I think the sooner we'll see an increase in uplift in ARPU from customers. And Spaces basically is a fully integrated product. We only ever put an employee or a visitor's details in once. And after that, then whatever modules we offer to them, whether they're car parking, EV charging points, lockers, meeting rooms, desks, they can actually log in to whatever the company is actually subscribed to. And it's we've shown it to some customers, and we've had a very positive reaction at the stage that it's at now. We made great progress over the last few months on the platform, and we're expecting to, as I say, we expect to bring it in ideally this half, but we've budgeted more conservatively than that, and that's where we've actually put most of our development efforts over the last 6 or 8 months in particular. Space Connect, small growth in ARR. We've seen a little bit of churn in this business, mainly because we had customers who were on annual subscriptions. They'd bought us originally for social distancing in the workplace. When that pressure eased as of last year, then they decided they didn't need to carry on with the product. But we have seen growth. They had a very quiet start last year, but it picked up from May onwards. But that's been a little bit negated by churn. Again, when Spaces is complete, we'll launch it first with Swiped On, but eventually it'll also become Space Connect 2.0. So that will be in effect our new platform. So we'll end up with one technology stack that we offer to all customers, different price points with different levels of functionality exposed. We've seen I think we reported on this previously, that there is definitely a longer sales cycle. Some of that is driven by economics, but I think ultimately it's probably more to do with the fact that there's a lot more people involved in the decision-making process. The net effect of it, though, is positive, because you end up with customers who are definitely more committed, and we become a key part of their ability to sort of shrink the real estate space by using our technology. And it's very much a must-have, and it's based around optimization of their space. Evoke on ASO has done well. We only billed 100,000 on that last year. It's now up to 400,000 of billings, and nearly all of that came in the second half of last year, and a lot of it was concertinaed into the last quarter. So we're seeing a good progressive build as we move forward. So I think that's very positive for us, and it obviously makes a big difference for us in terms of cash. And we did get a decent order from a customer in the Far East just before period end. We haven't recognized it, and we won't recognize until we deploy, but it gives us an idea of the type of customers we want to focus on for the new year. And as Chris mentioned earlier, Space Connect has been cash generative since July of 22. A&K, there's not a lot to say there. As you know, the main thing with that business is get it back to its beat. That was there before COVID, and we were well on our way to doing that, and you see that we're up 22%. We did actually receive a large order from a UK academic institution just before the year end, but we won't recognize that until we deliver. Had that come through, then the numbers have been higher again. But that business is in a good place. I mean, we've made no secret of the fact that ultimately, it'll find a place outside the group, I think, is the main thing. So we've become almost exclusively, we will be exclusively focused on just software. But in the meantime, it's trading well. It's not consuming cash, and we're seeing a sort of a definite return to that business since COVID. In terms of markets and competitors, I mean, I suppose hasn't changed a lot since we reported last. There's been more acquisitions. PSG have actually bought 4 businesses between November and January of this year. One of them was a direct competitor of ours, but based in the Nordics. It was, I think, and this is anecdotal, they had an ARR of I think about 3 million euros, and the information we have is that that business was sold at about 30 million, so 10 times ARR. There's no doubt that there's increasing emphasis on financial metrics. A few years ago, if you had a strong ARR business, even if you're losing money, you were able to get big premiums for in terms of the valuations. The message is very clear now that businesses that are cash generative are really the businesses that will attract the premium. And our job now is to work on 3 areas of value in our business. Get the SaaS metrics, which we've got, so 30% growth, etc., that you'd expect from a strong SaaS business. And then we've also got strong financial metrics, cash generation and profitability, and then strategic value. And key to that for us then is actually getting a stake in the ground in as many overseas markets as possible, in particular the awkward markets where the non-Roman character sets and where there's particular quirks to the market like Korea and that, rather than going after easier markets where but equally then where there's actually more competition. There's been 1 or 2 other interesting developments in the space as well. There's been a few new businesses enter in terms of investing. Atlassian made a strategic investment in Robin, who are a competitor of ours in the US. But the picture that I think we laid out in last year is very much the same. There seems to be 4 or 5 major consolidators in the market, and they're all very active. They seem to have deep pockets and are absolutely convinced that there's a market to be had here. And and from our perspective, there's actually not a lot of good quality assets out there that people will can buy. And our job now is to make sure we optimize the business so that at the appropriate time someone may come and want to take our business out. But I think we're on the right trajectory now, and this year has been a significant milestone. And you'll see an increasing emphasis on us in driving through to profitability and cash generation. Behind the scenes, we obviously managing our cash, our costs tightly to again optimize that, and we have no big investment required to do what we're going to do. So we're not saying, oh, we get our numbers, but we need to invest another £500,000 or £1 million in additional marketing or more people or whatever. We're going to achieve what we need to achieve with the resources that we have. So the general message really is we're despite the general sort of economic factors affecting us out there, we're heading in the right direction, and we're ticking off those sort of milestones on our path to where we need to get to. I think that was it really. I think just generally all is good, and we've got our heads down, our tails up, and driving on.
Frank, Christian, thank you very much indeed for your presentation this morning. Ladies and gentlemen, please continue to submit your questions using the Q&A tab situated on the top right corner of your screen. While the company take a few moments to review those questions submitted today, I would like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Frank, Christian, as you can see, we have received several questions throughout today's presentation. If I could just hand over to you to go through the Q&A tab, read out the questions and give responses where appropriate to do so, and I'll pick up from you both at the end. Thank you.
Great. So the first one.
So the first question is, does the company now expect to be free cash flow generating going forward for FY24? Yes, we do. We've got a plan in place for the next year. We will be break even on a cash flow level. As I mentioned before, we would expect that to go down a little bit in the first half of the year, but overall for the year, we will be break even, we believe. As mentioned, Swiped On has been generating cash for the past couple of years, and Space Connect has also started generating cash, so we see that as continuing in the coming year.
Great. There's one there on the reason for the change of auditor. I'm sure when people saw that announcement last month, they thought we'd have falling out with our auditor. We did actually have a falling out. It was actually more to do with how much they wanted to charge us rather than the fact we'd done anything wrong. The net effect really is by going with the new auditor, we're saving the equivalent of about £60,000 or £70,000 a year, which I think is quite for a business of our size is significant. So purely financial, not operational. And as you know, there's a lot of change in the auditing industry, and the view now is that the bigger guys are just charging an awful lot more money for their services. Yeah, we'll have there's a couple of others just up here, isn't there?
Yeah. Question here: What is driving the higher churn at Space Connect? Would you expect this to normalise going forward? What is the target for new Space Connect customers ex Voco on an annual basis? So I think Frank mentioned before that this is largely coming from the remnants of COVID. We had a lot of customers who joined us once the lockdown started to get released in around about the spring, summertime of 2021. The annual renewals came up the spring, summer of 2022, and some of those either contracted or left us because they no longer need us for social distancing. I think as you see on the graph which was presented there earlier, there has been good growth within Space Connect ARR throughout the year, but that has been to a certain extent offset by the fact that we had some of those COVID churners as well.
It's probably important to highlight as well, when we're talking about churners, we're talking in sort of 7, 8, 10 or 10 customers out of a base of 70. So it's not like half the base have churned. So I think it's, and we do expect it to normalize, and we're looking forward now we don't think there's many others in there that might churn like the ones that have gone. I think from now on, we should be looking at net growth. And saying all of that, we've been very conservative in the budgets that underpin our base case, which ultimately is would feed into whatever projections are in the market. So we're not, our key priority really is that we make sure that we hit or beat market expectations going forward. And run the business accordingly. And Chris has been putting a lot of effort into that side of it, and hence the decision around things like the auditor and anywhere else that we can actually make sure that we save costs. There's one here: are you growing customers in Swipe Down as well as locations? We are, and again, for us, we've customer growth's important, but equally, you see a customer in Swipe Down that might only represent one customer on the list, but actually could result in 20 or 30 locations. So their ARPU value is quite high. Again, we've November, I think we signed 100 new customers in Swipe Down, which is the highest number of signups we've had in probably a couple of years, and we weren't far from that in January. So the general trend is to get back into the momentum of signing customers, and equally then as Spaces emerges, to actually focus on cross-selling into the existing base with a view to driving ARPU. So customers, locations, and ARPU are all priorities for us. And again, we've I think in our last presentation we mentioned that we'd brought our marketing, which previously was with an agency, back in-house, and the marketing team in New Zealand are doing a great job on that, and we're noticing a higher volume of leads and a better quality of leads coming through as well, which is what manifested itself into those high conversion months in November and January. So I think, yeah, it definitely customer growth, definitely location growth, and overall ARPU growth are sort of our main focus of our sales effort in Swipe Down for the coming year.
Question here: when does combined Swipe Down Space Connect solution go out to clients, and when does cross-selling start in earnest between the two divisions? We have it in our budgets that will go out, around about the August time, but hopefully it will come out earlier than that. We're expecting it to be more like the first half of the year. In terms of, we will still sell those as two separate products. So we will still have the Space Connect product, which will target the more higher end of the market, and we'll have the Swipe Down product, which will go directly to customers. And so it won't be quite so much that they'll be sold as the same product. They'll be sold separately.
Yeah, it'll be the same platform underneath. The new platform is fully white labelable, so it'll actually be rebranded as Space Connect 2.0 in effect, but behind the scenes, same technology, but there'll be certain features available to the Space Connect level of customers, tend to be higher ARPU spending customers. There's another question there about upsell opportunities for Spaces. We believe it's significant, even though we've budgeted to be very conservative. If you take a typical Swipe Down customer with a single reception, the most they'd spend with us now is probably about, maybe $150, $200 a month. If that customer happened to have 200 desks that they want to manage, then that's 200 times $4 a month, say. If they had 100 parking spaces, that's 100 times, say, $4 a month. If they had 20 EV charging points. So you could imagine then it's like an inverted pyramid of opportunity. It'll very much depend on the customer and their needs, but the idea is to have more things that we can sell. Our ambition is probably to have 5 or 6 different modules that people would actually pay for in Spaces.
So the question here: what revenue profit contribution are you expecting from NASO in FY24? So we continue to be quite conservative in our forecast for NASO. We basically forecast based upon what we've got historical experience on. So, in our numbers, we mentioned there that we got £400,000 of billings from NASO in the previous financial year. So when we look forward, we in our budgets, we look at a quite conservative number on a similar basis. There is obviously good opportunity for that to grow. A lot of that £400,000 of billings which came in last year came in the final 6 months of the year. So there is good prospect for that to continue to grow in the coming year. The way that NASO works is that we do get on a lot of the products which are sold through NASO, we get the revenue up front for up to a period of 5 years. So the actual cash coming in up front can be significantly more than we actually get revenue. So it takes time for that revenue to build up as we release it over the 5-year period. So from a pure cash perspective, it's very, very were very good for us, and from a revenue perspective, it takes a bit longer for that to feed through to those numbers coming into the accounts.
There's another one here, which is what does the future hold for new products and new territories and sales into new territories. In terms of new products, ultimately, it's all going to be based around spaces. Now, we've the technical guys have done a really good job on what we're building, and instead of us going out and building a pile of sort of point solutions like a dedicated parking space management solution, a dedicated desk management solution, we put all our energies into building a really robust platform that in turn allows us to layer in functionality. So the time to market for new modules going forward will be really quick compared to building as I say, dedicated solutions for each of those areas of functionality. But ultimately we will start with the 4 or 5 key ones, obviously visitor desk, meeting rooms, car parking, EV charging points, and lockers and bike parking spaces, all of which are their assets that people in companies will want to book, reserve, and when they get there, check in. So similar dynamics behind the scenes. In terms of new territories, I mean, we've budgeted to do a certain number this year coming, and we've been, for us now, with the last 6 months, we've spent our time just sort of learning from our experience in Korea, selling into a non-English speaking market with a different search engine culture that required a different level of understanding, engaging with customers who tend to buy slightly differently than our traditional markets. We're then applying that learning to the next number of countries. We could have gone sequential and said, okay, we've done Korea, let's do one more. But what we want to do now is stress test this model that we've created to see, can we go from 1 to 3 countries simultaneously? Because if we can achieve that, it means that we can roll out in other markets really, really quickly. Behind the scenes then, we've been ultra cautious in our budgets in terms of setting expectations. So we don't have expectations internally around what we can do in China or Taiwan or whatever our product would be. Our priority is get the product out there and then see how it goes. And once we get a bit of a beat, then we can then come back and look to see what it's going to adjust to our numbers. But if we do achieve reasonable sales, there's not a lot of cost associated with, so the margin contribution from those markets should be really good. But and I suppose ultimately behind the scenes, we've almost taken the view that it's almost as fast and as cheap for us to go into one of those markets like this than it is to go and commission a bit of research that may or may not tell us that there could be a market for a product, and we still got to go and spend money to validate that thinking. So, but it's really important to us, and again, we're not going to confine ourselves just to the Far East. There's a big opportunity there. We've already got swiped on in Spanish, so that opens up other markets, and we've got one customer in particular who's got quite a presence in South America, who would be keen for us to put stuff out there. We're dealing with another customer in French-speaking Canada, which meant that we've had to do some French translations. But behind the scenes, I think we've actually got a really good model now for rapidly converting into local language. We've also adopted the way we charge. We currently take money in 7 currencies, I think, and we're going to expand that now to include all these new markets. So if you buy in China, you'll pay in renminbi, and similar in Korea, won and that. So ultimately, the ability to get in there fast, to get in there really quickly, to limit the amount of expense that we outlay to validate a market is at the heart of our strategy. And then if we find that we're doing well, we can put more marketing dollars behind it.
One here, given the ARR of 5.8 million and expecting continued progress at A&K, would it be fair to conclude that Canaccord's revenue forecast for FY24 looks very conservative? I think we've made it quite clear that when we're doing our forecasting and budgeting, we are conservative in that. We want to make sure that the numbers are something that we are sure that we can hit. And in terms of our internal ambitions, our internal targets, they are more stretching than the numbers which are in those Canaccord forecasts.
Yeah. Another one here. Swiped on locations, growing that to 8,000K was good. Or sorry, 8K or 8,000 locations in the near term. Is the near term ambition to get it past 10,000? And could we discuss the medium term potential? We get multi-location customers in 2 ways. There's existing customers who expand out, and across the group right now, I think we average about 1.7 locations per customer. So we'll have small fast deals where customers 3, 4, 5 locations. We can normally do that as part of an upfront deal, and that really involves just the salespeople engaging with the customer and then realizing they have multiple locations. And we do get customers come to us say, actually, I'm looking for a system to go across these sites. The second category of multi-locations then are sort of more sizable, but actually with relatively short sales cycles, where you end up with sort of 20 to 30 locations. They tend to be a little bit more involved in terms of selling effort, but actually the deal normally can come in sort of probably anywhere between sort of 4 and 12 weeks. The other group, which is where the big step change can come, is what we class as enterprise deals, but enterprise in terms of footprint, not deployment or anything like that. And there where you're dealing with customers with probably 100 plus locations. Again, we've been very conservative in terms of our external numbers, but behind the scenes, we've got a number of quite large enterprise deals that could give us a decent step change in locations if they came in. But the nature of deals like that is they can go sideways. We could lose out at the last minute to a competitor that suddenly gives something that we can't offer. But we have to change our sales mentality selling into those. And I think over time we've got better at engaging with those customers and more importantly then altering the software to fit that requirements. We've got customers now where they might want us in a few hundred locations, but across multiple geographies. So having it in multi-language, but also having in-region hosting is really important to those customers. And I think the back-end work that the dev team have done over the past 18 months are instrumental to us winning those deals. Whereas a year and a half ago, had we been pitching, we probably would have got maybe past the first round. But once they realized we didn't host in Australia or something like that, it was a big problem. We've had some interesting ones now with German chemical company, for example, looking for a system across multiple locations in the Far East. And funnily enough, the markets we're going into are also on their shopping list. And I believe they've told us that none of the competitors they spoke to could actually offer that level of functionality. So I think that combination of multi-country expansion will actually increase our ability to sign larger deals, combine them with our ability behind the scenes and from a sales process point of view to be able to service those customers well and get the sales done efficiently. Whilst we call it enterprise, the values aren't huge in the normal concept of enterprise, and we don't have the sales infrastructure to sort of spend a lot of time on the sales effort. But what we do, we want to do really well and do it quickly and bring a deal in as fast as we can. So definitely the ambition is to grow locations, and it's a key metric for us of the sort of 15 or 20 metrics. That's in the top 3 or 4 every month that we look at. And I think there's another one here about you seem really bullish yet refuse to buy shares. Why? I mean, one of the challenges we have in our business is always things going on behind the scenes that actually makes us inside. So even if we want to buy shares or not, we're precluded under the rules, and that generally is the main reason why. And it's frustrating for us. But equally, we have share options that sort of focus our minds on making sure that we drive the business through and that. But yeah, I mean, the reality is like that. We have to abide by MAR rules and everything, and we can't just buy shares whenever we want. And we've had times where we spent an entire year under those rules where if we wanted to, we couldn't spend. So that's the main reason, really. I think in terms of Space Connect, one last question then. You mentioned prospects for expansion 24 for Space Connect. More detail. I think one of the things about Space Connect as it sits today is that we only sell that product to English language customers. Now, whether they're in the UK or not, virtually all our customers are either in Australia or in the UK. Now, obviously, the general economic climate in the UK, we've got to be cognizant of that going forward. And if we do get a few shocks this year, we want to make sure that we're not just dependent here. So as a result, we've been very active in the Far East and indeed Australia. We picked up a customer in the Far East there recently, and just before the period end. We haven't delivered, so we won't recognize that until we start to deliver. But there's big expansion potential with that customer. They're currently one location. They've got 47 locations. So I think picking off deals like that will be really important to us. Back here in the UK, obviously our biggest partner is Softcat. We work really well with them. The guys in Space Connect work closely with the individual salespeople within Softcat across their 7 UK offices. Our 2 strong areas in that business are public sector, so sort of health service on one end and people like the police on the other, across to academic institutions. And then financial services tend to be our main sort of private sector win areas. So we want to put our energies into those. We're probably not going to do a lot on Space Connect in North America. We pick up a few customers, but the view we're taking is, we don't have the marketing dollars to chase that business over there. It is more competitive than here. And even going there to serve the clients is expensive, both in terms of cost and time. All of the work we do in the Far East is done remotely from the UK. So I think sort of expanding out into sort of Far Eastern markets is a way of diversifying away from the UK. As we bring in Space Connect 2.0, which will be on the Spaces platform, and that definitely will be towards probably the last quarter of the year. We launch it as Swiped On first, and then Space Connect later on, because there's more features that we got to bake in there. We will then have multi-language capability, in-region hosting, and all of those things that currently aren't available in Space Connect, and that obviously then will bring in a different sales approach, but also I think create a larger addressable market for that product. And I think that was about it, really. I think we've covered most of the questions. Yeah.
Frank, Christian, that's great. Thank you for that. And I think you have addressed all the questions that came through from investors today. And of course, the company will review all questions submitted today, and we will publish those responses on the Investor Meet Company platform. But Frank, perhaps before redirecting investors to provide you with their feedback, which I know is particularly important to you and the company, could I please ask you for a few closing comments?
Great. Well, firstly, thank you very much for your time this morning. And it's good to be coming back with news that I think some people were expecting maybe we'd have bad news to deliver, and it's pleasing to know that we haven't. I think we're sort of working well behind the scenes. Dynamics in the market are just as we described previously, and we're just executing on the plan that we articulated as we moved through last year. So just keep doing what we're doing, I think, is the message. And we look forward to speaking to you when we come out with the full year numbers finalized, probably around May time.
Frank and Christian, thank you once again for updating investors today. Could I please ask investors not to close this session, as you will now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, and I am sure will be greatly valued by the company. On behalf of the management team of SmartSpace Software PLC, we would like to thank you for attending today's presentation. That concludes today's meeting. Good morning to you all.